Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today we have a very special guest, close clients of mine, and who has been investing in real estate for a number of years and has attained financial freedom by the age of 29. So I figure we could all learn a little bit of information from each other, learn from this particular successful individual investor. Welcome, Kellan.
Thank you, Cherry. I appreciate that.
Yeah, I wanted to tell everyone a little bit about Kellan first. Kellan has built a portfolio of 84 units, currently worth about $14 million, which is fantastic. And there is no joint venture money involved. So I also want to find out the secret of building this portfolio without joint venture, because I don't want to work with joint venture partner myself. And he specialized working in one thing only, which is the BR in multi-family real estate to achieve financial
That's
independence.
hilarious.
Now, I don't know what all these R means. I think somehow there's refinance and rents and I don't know. So there's something in there, and I'll let you talk about it.
For sure. Yeah. Thank you. Thank you for the nice introduction. It's buy, renovate, rent, refinance, repeat. It's just the idea of, buy a property, add value, and then re-access the equity from the bank. And that's sort of that's where a lot of people get hung up when it comes to scaling a portfolio without partners, is they run into roadblocks with financing, or they're not buying the right deals that allow them to add enough value to bring it back to a bank and actually pull enough equity out to apply toward the next deal. So that's something that, with the way that I approach investing, I've had to become a specialist at finding great deals and knowing how to work with lenders. And so for a very long time, I barely worked with any private lenders at all. I was worked with Scotiabank for the first 10 properties. And then after that, I've started working with credit unions, which actually was took me longer than it should have to find out that that's a really great option for someone in my situation, because people just weren't really talking about it. It seems like now people are a lot more public about it and they're speaking about it, which is great. But I know that for me, I was like, oh, credit unions are a thing. And this was in 2019 or 2020, and which is really not that long ago. And it was like, why is no one talking about that? Everyone talks about, you have to now move into commercial real estate. You have to start buying apartment buildings, and you can't really buy 2 to 4 units anymore because banks don't approve lending on that. But credit unions do. And it turns out they actually tend to be one of the better options for apartment buildings as well, I've found. So yeah.
I remember we had exchanged multiple contact information from multiple credit union. And so you are the expert in this. Tell us a little bit about what the primary difference is between credit unions and traditional, like say, big 5 banks.
Yeah, so they're localized to a certain area. So every credit union kind of has, there's like Libro Credit Union, Main Street Credit Union, Meridian Credit Union. If you're in Northern Ontario, there's a whole bunch there. Out west, out east, same idea. So depending on where you're located, they might say we'll work with you if you are within if the subject property is within, say, a 2-hour drive of any of our offices or something like that. Every credit union has their rules, but they're more localized. And then the other part of it is they're smaller and they're a lot more flexible, I've found. So you can, first off, most credit unions, when you start working with them, they kind of want a bio from you. Like, who are you? What's your story been? What's your plan? Which is just really nice because, it's a stark difference between the experience of working with, larger banks where they don't really care what your story is. They're only looking at a very specific set of criteria and checklists. But I've found plenty of times where I'm able to be creative with credit unions that I wasn't able to find options elsewhere. So yeah, mostly flexibility. And they also tend to be a really great option if someone, say, has built a portfolio that has good income, and then maybe they can qualify for mortgages without the need for a 9-to-5 or self-employment history. So that was the big thing for me, is not only did I hit the 10 property mark, which is when Scotiabank tends to cut people off if they can get to that point. But so not only could I not work with, traditional lenders because of that, also because I quit my day job, so I didn't have T4 income anymore. And so both of those criteria are not a concern when it comes to working with credit unions, as long as your portfolio has sufficient income.
Yeah, that is also a very interesting point. Like, for a lot of people who are starting out, they would have their they typically use their own personal credit to qualify for financing. As you progress into this investment world, you accumulate more cash flow. You would then be able to use the cash flow of the properties to qualify for financing, which is a big plus. And then now you're really working, you're really treating your real estate portfolio as a real business. And the way that I like about you or your personality or your business is that you're not afraid to try new lenders. And I don't see that a lot. People typically hit a roadblock with lending, and then they're like, I'm done. I don't want to keep going. I don't know what to do with my portfolio.
Yeah.
You know?
Yeah. And it has been a process of bouncing around a bit. Even with credit unions, some tend to be more aggressive during certain times. So, there were some credit unions I worked with for a few years, and I got like up to 9 million in mortgages with one credit union. And then as of more recently, another has been a lot more aggressive in the lending space. So it's been, they can do things like even like a step up covenant sometimes, where they kind of look at, so a lot of credit unions are going to look for a 1.2 DCR or higher. And, that can be difficult in this environment, but they're going to look for 1.2 or higher. And then some credit unions will actually look for more like a 1.1. So they're actually a little more aggressive, which results in a higher loan to value. So you can pull more equity out. And then they can sometimes even from further apply a step up covenant, which allows them to essentially look at the projections for what rental income could be in the coming 3, 5, whatever years as the term progresses with them, as you turn units over, as you get rents up from various strategies and things like that. So if they can see somewhat of a plan for how you tend to approach that, then they can actually they can end up resulting in a even lower debt coverage ratio and therefore a larger loan based on potential with the property, which is something you generally don't see with commercial lenders. If you want to get larger loans, then you tend to you have to kind of go toward like commercial CMHC loans, which can be a perfectly reasonable option for some people. But a lot of people really overlook the significant CMHC commercial fees. Right now it's like 5.3% or something, of the loan amount. So that could be tens, hundreds of thousands of dollars, depending on how big your apartment building might be. Whereas you don't have to deal with fees like that with credit unions. And you tend to have a little more flexibility. Maybe a couple of years down the line, you've turned more units over, you've gotten rents up, you can actually bring it back in for an additional refinance potentially. Whereas with a commercial CMHC loan, after you basically hold it for 5 years, and maybe you reapproach after 5 years, but it tends to be more of a product that is valuable for a fully stabilized building.
Yeah, and I also heard recently that CMHC had changed their refinancing policy as well. So it may not be available to a lot of people who are trying to use a blur strategy.
Yeah, and I've heard rumors and examples, I suppose, of where CMHC actually really wants to see another lender having already worked with you and sort of like vetted that debt in the first place, and so they kind of want to see that. You also have to bear in mind that it's like 6 to 10 months for an application, depending on how backlogged they might be at the time. And then the significant fee that's worth considering as well. Now there is an argument for it. If you have private loans you want to pay off, maybe paying that 5.3% fee makes sense so that you can then access more equity and use it toward paying off higher interest loans. So there's probably arguments for it depending on people's situation. But
3 is quite a bit.
Yeah, it's a very significant fee. So I've actually never done one. I've done applications for them or like pre-applications, I suppose, for them and looked at what the potential could be. And it was like, yeah, I can access a little more equity and the rate will be a little better and the amortization is a little better, but it comes with this very large fee. And I try to balance that out depending on my situation. And, if you're in a position where you don't necessarily need that extra 50, 100 grand or whatever, then maybe it makes sense to get the better terms without the fees and things like that. But it's highly dependent on the subject property that you're looking at and then your own personal capital situation.
I think the thing that I really appreciate the way that you run your business is that you're really digging into the numbers. Majority of the beginners out there, they don't look at the numbers as closely as you do. And would that be one of the reasons why how you grow your portfolio like so aggressively over the last few years?
Yeah, I think it's one of the only ways. I mean, part of it is luck with the market, right? If markets go up, then everyone does well. But you see during markets like this, the reality of things when the tide goes out. So, if you don't have like if during 2016 to 2020 or so you didn't have a very high cash flow portfolio, a lot of people are running into a lot of trouble now. Luckily, I had a very high cash flowing portfolio that also had lots of equity in it available to tap into. And so, understanding the numbers, I think a lot of people would love to understand the numbers. I think it's just that they don't know how to go about doing that, and where the right resources are for that sort of thing. So I think that's a big part of the challenge for people. Having spreadsheets that aren't overly complicated, that sort of thing. So, I try to share a lot of that in what I do. But it's a big roadblock for people. And especially when every lender calculates things differently. So I've had to, over the years, learn how each lender approaches their calculations, because oftentimes they can actually just share one of their spreadsheets with you. This is how we're doing our math. Perfect. I'll just do the math for you. And then when I present them a case, I already know vaguely what they might consider loaning. And even just the magical question that I tend to ask a lot of lenders, which is, assuming an infinite appraisal value, what would the largest loan amount be that I could get here? What's the largest principal I could receive, assuming an infinite appraisal value? Because for some years there, appraisal values meant everything, because you'd get, say, 75 or 80% loan to value almost regardless of the appraised value. Now the bottleneck is no longer appraised value, it's income and expenses. So let's assume they get an infinite appraisal value, because these days you still tend to get appraisal values far beyond what they're actually worth or what they'd actually sell for. So people are kidding themselves to some degree. But then, let's assume we get that maximum value. How much of a loan can I get? And that's a good question to ask multiple lenders, so that you can see how much equity you could possibly pull out of that building.
That's great advice. And I know you do coaching as well. So through your coaching session, I assume that you will share all your spreadsheet and your insight and tips and tricks with your students, right?
Exactly. Yeah. Like I do one-on-one coaching, and then I do masterminds as well. I'm actually releasing a mastermind in January of 2024. And that'll be an ongoing group coaching mastermind. It'll be a 1-year term, where you get a course that I put together that has 16 plus hours of content. It breaks down all the math about how to do these things, and how to scale a portfolio. And then we have one-on-one or group calls, where we can dive into people's more specific situations and just share how things are going for people, because markets change monthly. And so staying up to date on how things are going and getting a feel for, even just sometimes knowing I'm not crazy, I'm dealing with the same challenges as 10 other people, is a really helpful thing just for people's mental health during a time like this as well, to know that they're not alone, and that maybe other people have come across these these challenges, and now they have strategies to approach them and resolve them, because strategies change monthly. We have to pivot a lot in a market like this.
Yeah. So speaking of strategies these days, what are you doing? Are you buying? What are you busy with?
So I did actually buy a triplex recently. I wasn't planning on being in acquisition mode, but I got a really great vendor take back mortgage, so I figured I had to take the deal on. I bought it with it was 10% down, and they held the rest. So it was I paid, and they held the rest at 6% interest only for 5 years. So I was really happy with that, because it's cash flow positive on day one, and it was only $42,000 down payment, because I paid $425 for a triplex in London.
Wow.
So it was a great deal. I was happy to add it to the portfolio. I wasn't in a place where I was like, oh, I've got a whole bunch of capital and I can't wait to go acquire some things right now. I've been doing plenty of renovations and things like that. So I wasn't planning on being in acquisition mode. I was still in stabilization mode. And generally, you can't really stabilize while acquiring. But I couldn't really turn that deal down. But otherwise, the vast majority of what I've been doing has been stabilizing the portfolio. And for me, that means increasing rents. So doing a lot of cash for keys, especially because I'm in Ontario, you tend to have to pay tenants to move. So paying a lot of tenants to move and then getting the rents up. A lot of times I can get rents up in my units by $300, $400, $500, $600 a month sometimes.
Wow.
So dramatic change in monthly cash flow in that scenario. So a lot of that.
How much do you have to pay?
It's like between 2.5 to 10 grand usually. Depending, if there's like someone where their unit could rent for $500 more a month or $600 more a month, which I've had multiple of, $10,000 cash for keys is not a crazy amount of money, because you get your money paid back around, within not very long. A common formula that I'll tend to use is like, what's the delta between what the current rent is and what it could rent for? Say that's $300. Then what's, how long would it take to get your cash for keys back? So let's say $300 times 12. So 3,600. So easily you'd happily pay $3,600 for that tenant to move, because you get that money back within a year, and the values of the building has gone up significantly. Your debt service ratios with the banks as a whole for the portfolio have improved, as well as for that subject property if you're planning on bringing it in for a refinance. So that formula works really well. Now, the challenge for a lot of people is capital. And so for that sort of thing, if you don't have recent refinance funds from that you can put toward, the cash for keys and then the turnover renovations, private financing is a useful thing to approach. But that being said, it comes with a massive asterisk beside it, because lenders need to be aware of the amount of people defaulting on these types of loans recently, and borrowers need to be aware of their plan for paying these loans back out. Because I've done plenty of private loans over the years. I actively still do right now, promissory notes and things like that. And, I don't recommend most people lend out on promissory notes, but I do borrow on them personally, because I work with friends and fellow investors who know, like, and trust me. And so they're not concerned about getting their money back. But so I use that toward, turning units over, getting rents up, and then be able to bring it back to the bank for refinances. And then, of course, people can look at second position loans and things like that as well. Or, if you're a highly competent investor and you really want to scale, you can look at borrowing from people's RSPs and TFSAs, and there's plenty of strategies to apply there. But I've actually not really opened much of that can of worms. Mostly prom notes thus far. I've actually never done a second position loan.
Oh, good for you. Now, so my next question for you is, there's always that question, like, even in my mind, like, I think it's a little bit of mental shift from working full-time for someone else and having that steady income to jumping into full-time real estate investing. Virtually, you're building essentially just your net worth.
Yes,
right?
Exactly.
And there is not a lot of cash flow. Like, yes, maybe there's some cash flow coming in, but you're currently in the stabilization period. So how do you manage that mental shift? Like, how are you managing your cash flow in this particular situation? Because you don't have steady income coming in.
Exactly. And that's an amazing question, because, the answer used to be just build a portfolio that's high cash flow. That can be sort of the income you can kind of live off of, sort of. But then you also have the competence to be able to then, and the skills to be able to then take on more deals and make more money that way. But like you said, the reality is a lot of people are living off of refinance funds, which I'm sure has its tax implications. You're technically not even really supposed to.
Yeah.
I think, and I've been pondering that question for years, because, for a while there, I had significant cash flow. It's mostly all gone. Some properties that are positive, some that are negative. And so now it's not really income, that I don't look at it that way. And so a lot of people are coupling it with active income during that time, whether that's a business of some sort, whether they have a job still or whatever it might be. But I think that the other answer is sometimes you need to cash in a little bit, which is not something that I talk too much about, because I've really been an advocate for people just buying and actually holding, because very few people I know that actually hold a building for more than 5 years, which is the whole point, in my opinion, of buy and hold real estate. is holding it for 10 plus years. But maybe 20% of kind of looking at the as an 80-20 thing, I guess, and like trying to maybe take 20% of whatever might be refinance funds or the sale of a property or whatever it might be, and set it to the side so that that you're covered, and that you're still focusing on scaling a portfolio. And it's a hard thing for people to wrap their heads around, and I think for good reason, because people shouldn't leave a steady income if they don't have a good foundation beneath them to fall back upon. And so for some people that might be a bed of money. Basically, it might be $100,000 in their bank account that I feel good to leave my job because I've got cash in the bank. That can be a version of your foundation, and time to build a business of some sort. But I think it is sort of cashing in maybe every once in a while. Maybe you have 10 properties, maybe you sell one. It allows you to access a chunk of capital that you can feel safe to have.
So you never consider like all these other active real estate investment strategies, such as, I mean, what you're doing is very active, to be honest. You're running your own business. It's just from a tax perspective. It may not be called active, but there are other strategies like flipping and also doing rent to own, more like private lending. These private lending is not quite active, but flipping and rent to own could be considered active, right?
Yeah.
Or you're not interested in doing any of that?
No, I'm not. I've always been just laser focused on scaling a portfolio over a long period of time. I have the coaching, so the reality is that is part of my active income. But I've always been just laser focused on scaling the portfolio. It's where you build, in my opinion, where you really build long-term wealth is just building that equity, getting the long-term mortgage pay down and appreciation. And so it hasn't been an interest of mine. I've done like one wholesale, basically. My wife's done a couple flips actually. And so we're married now. So we have, that's essentially, I guess, part of our business. But no, it's been just focused. I mean, I think that like there is an argument for it, but I think if people are going to take on flips and things like that, I wouldn't want people to use their hard-earned capital that they've earned through their day job or through their business or through their refinances and use it for flips, because I want that snowball to keep rolling for people on the portfolio side. And so if they want to take on flips, I never talk about partnering and I never talk about flipping, but if people are going to flip, I recommend they partner, because in that scenario, maybe you have someone who trusts that you're capable of flipping. They loan you the money. You guys do the deal together. At least you're not using your own capital, which should be, in my opinion, used to continue scaling your portfolio. So that's sort of how I view that, because I don't think it makes sense to use that capital and lose the momentum on the acquisition side.
Yeah, for sure. But that is also going to help you alleviate some of your short-term cash flow issues that people are facing today.
Yeah.
Now, with that, let me ask you the final question. What advice do you have for investors to thrive in today's market conditions?
Yeah, I think that it's about utilizing a bunch of strategies that are valuable in this market. So vendor takebacks are a really interesting thing. I think people should just be throwing a bunch of offers in and asking, "Are you willing to do vendor takeback?" You don't even have to throw an offer in. You just need to call a realtor and say, "Are they willing to do vendor takeback?" If they are, then you can look at that property to see if it has potential. That's one of those sweet spots we're in as of this moment, in like late 2023, where you can, there are people who are more motivated to sell for a variety of reasons, and more likely to offer those vendor takebacks, which right now is a really useful thing as a buyer because you can have lower down payments when liquidity is harder to find right now. And you can also do interest-only loans, maybe at better rates than what banks would offer, which is sort of the reverse of what it used to be. Vendor takebacks used to be higher interest. Now you can actually get them lower interest than what you can get with banks, and interest-only. So that solves your cash flow issue if you can get a long-term vendor takeback with interest-only, and then lower down payments, which sort of helps the liquidity side of the issue. And you can make these offers on market almost more often than off market right now, which makes things, as a buyer right now, it's finding deals isn't as much the hard part. It's about figuring out how to finance them. So vendor takebacks are one of the really interesting ways to do that. We're also seeing that like during these times, you know, how much reputation matters, because it's taken, you know, it takes people years to build a reputation and for people to trust you enough to consider maybe partnering with you during a market like this, or loaning you money during a market like this. And so those things are, you know, that's sort of a more of a said in hindsight type of thing. But, you know, building reputation as a competent investor, you know, and kind of building your foundation up as you go and not going too crazy on the acquisition side of things. Like just like take on a deal, make it, stabilize it, and then move on to the next deal, or maybe do one or two at a time, depending on your capital situation. Those would be some of the things I'd suggest. I'm sure I could go on forever.
Thank you so much for sharing your tips and tricks on like all these things, mortgage, vendor take back mortgage, also still doing deals in this type of market. That's very eye-opening. I'm sure it is very valuable for our audience here. And so for people who are interested in getting in touch with you, how could they find you?
Yeah, mostly on Instagram, kellan.james, and then my website, kellanjames.ca. That's where all of my one-on-one coaching is, as well as my mastermind groups, which are a lot more affordable because I can do them in a group setting. So going to be getting that community up and running in early 2024. It'd be great to see people jump on that.
That's awesome. Awesome. Thank you so much for coming on.
Thank you, Cherry. I appreciate it.
Yep.